Good evening, everyone, and welcome to tonight's webinar. Thank you very much for making the time. I'm honored to be here. I'm going to share as much as I can of value to you to help you have an understanding of what the property market is like at the moment. There's a lot of noise in the media. A lot of people are confused. Interest rates are moving. People are a bit nervous. And depending who you talk to, you'll get a completely different story. So for those of you who've never met me, my name is Jeanine Sciacca. I'm a senior consultant for 2020 Property Advisory. So we're a research-based property advisory business. We've been around. So the owner is Mike Anderson. I'll talk about him in a second. Mike's been in this game for over about 25 years now. I used to be a client of his years and years ago. 2012, I think. I first met him, that's 10 years ago. And I'm just very grateful to be able to be a consultant for 2020 because I had a very good experience as a client with Mike and did really, really well on the investment properties I bought from him way back then. So I'm going to share some valuable stuff with you tonight. If you have any questions, thank you, Hanbi, for putting your email address. Sorry, Hanbi, just if you can also just put your name together with that so I can get it together. So if you are from Meetup, I don't have any email details or contact details for you. I just don't. It doesn't work that way. Only if you came through Eventbrite. So please put your name, surname, and email address in the chat box if you'd like me to email you a copy of this recording afterwards and other information about investment property. All right. So tonight we're going to look at interest rates and how they affect the market. Definitely, all I can say is it's an interesting time we're in right now, and don't jump in too quickly to anything because of fear of missing out. However, sounds a bit contradictory. Once I take you through the information, the research, if you do know what you want, you need to act really quickly. And the reason is there's a real shortage of investment properties in the areas of significant growth right now. And I mean a chronic shortage, not even a shortage. So things are moving very quickly. But until you get to that point, don't just jump into anything. And just remember, at any time, if you have a question about something that you're looking at, you're welcome to ask me. I'm happy to give you honest feedback. It costs nothing. There's no charge. I want to just help people do the right thing. When I first came to Australia, I bought an investment property from someone else, not 2020, and it didn't grow. It was a brand new 4-bedroom house off the plan in a place near Geelong called Lewis. And when I met Mike, who owns 2020, and he asked me what I owe and what I own and what my goal is and all of that, and I shared with him the one I had, he told me to sell it because it won't make any money and to sell it as soon as possible because it's probably going to go down in value. I thought property never goes down in value. Anyway, I held on to it, and it did actually go down. I sold it 6 years after building it for $35,000 less. So I made a loss. It suited me at the time to sell it at that stage because I made $180,000 profit on one of them that I bought through Mike of 2020 property. So I offset the capital gains tax. The point I'm making is not every property is a good investment just because it's a property. So as a research-based property advisory business, we look at several forms of research. Well, Mike does, he's the owner. Several research, I don't know what you call them, pieces from different sources, and he puts them together. But above all, Mike is in the area. So right now it's in Queensland, about twice a week, every week, and has been since the end of 2015. So if anyone knows this market like the back of their hand, it's Mike. And 2020 Property has helped clients over the 25 years in Melbourne, in Darwin, in Perth, in Brisbane before, in Sydney, even in Broome, so Perth, so all over the country. We're not a buyer's agent for any particular area. We're a research company for the whole of Australia, and we operate wherever the best growth is. So I hope that helps you understand a bit about what we do. All right, so this is the owner of the business, Mike Anderson. I highly respect him. He's a friend and colleague, and I've known him for many years. And I like him very much because he does the right thing by people and always has. So Mike's got lots of experience in this game. He started off in finance, like a broker. He then was a financial planner, so he's very well versed in structures. He understands anything to do with trusts, all kinds of trusts, and whether you buy property in a company or a trust or your personal name, whatever it is. So he's very savvy there as well and can really help people really well. And out of the time in financial planning, he kept finding himself advising people to invest in property to grow their wealth. And they would come back to him because he was doing it himself in his personal capacity. And he was doing research then for himself. And he started to help clients with it and eventually got more and more passionate about helping people invest in properties in the right areas. And he had this research kind of proprietary model, and then eventually left financial planning and just went to help people to invest in property. And he's done over the time also developments as well as sales in both residential and industrial. So enormous and valuable experience, and as I said, around the country. So in my view, you couldn't find a more knowledgeable person on the subject. We're a small business, we're a small team, we're not a big seminar of 300 people type business. We're a boutique agency. We only get business through referrals and repeat business. We do not advertise a dollar, and the business is has grown significantly over the years. We do about 200 to 250 properties a year, and with a small team. Pearlie helps Mike run the office, and she's also a consultant. And then there's Helen, who does our admin and finance, and Ola, our marketing, and then there's Mike. So that's the team. Our business model is basically the research. So how we do it is we look for a mismatch in supply and demand at a national level. So when you've got a mismatch in supply and demand, you all know basic economics. If you've got a high demand for property and a limited supply, prices go up. By the same token, you've got an oversupply of property and no buyers, prices come down. So looking at that mismatch in supply and demand on a national level, we then find it in which state. So right now it's Queensland, it's no secret. Then within the states, we need to find the right suburbs. So that's the local government areas. And then we look at within those areas, what are the reasons for population growth? So if anyone's thinking about buying investment property and you can't understand how more people are going to move into that area and have a higher demand on residential, there's no reason for the prices to really go up, especially like now in Queensland, the property market's growing very well. We're looking at suburbs out of all of Brisbane or all of Sunshine Coast. Not every suburb is a good investment. Some are better than others. So we're looking for infrastructure changes, such as maybe the big hospital. The biggest hospital in the Southern Hemisphere is in Sunshine Coast. It's new. That would be an infrastructure change. If they put a new highway or expand a highway, that makes a difference. Putting in a train line somewhere, building massive shopping centers, a Costco, an IKEA, all these kind of infrastructure changes. And businesses, most important, business moving into the area, because that causes employment growth. And where there's employment growth, there's a high demand for residential property. And then we look at entry options. That just means, what are you looking to get? Are you looking to get a 2-bedroom townhouse, or are you looking for a 4-bedroom house with 2 living areas? What is the entry option? So that's quite important to know what it is. And then demographics. Demographics is hugely important, because when you think about the people moving into that area, you want to have the correct dwelling that you're buying today, that as the market grows, because of all this infrastructure change, the people that are moving into the area that want a place to live want to buy what you've bought 3 to 5 years earlier. That's how you make the profit in residential property. So we want to know, are they single people? Are they bustling families with many kids, want a big house? Are they retirees? So that's why demographics is so important. Now, the most important for us as a company is exit. I don't think everybody who sells investment property, I don't think anyone who sells investment property ever says exit. People sell you a property and they say, have a nice day. We ask the question, how do you exit this property for a profit? In other words, who would buy this property off you in 3 to 5 years from now, or 6 years, whatever it may be, at a profit, and why? Why would they pay more for it? Because if you can answer the exit question, you reduce and mitigate a lot of risk because you understand why the property is going to grow. If someone can't tell you the exit strategy of a property, I wouldn't buy it. Same as my Geelong house. 6 years later, sold it for 35,000. And you know what? That was in 2016. Today, it still wouldn't have made money where it is because there's so many new houses there, way better than mine that would be so many years old now. And they're about the same price. So why would they buy a 6 or 10-year-old house? So never believe that property always goes up. And if it takes 20 years to go up, sorry, but it's not a good investment. So we're looking at the areas of strongest upswinging growth in the relatively short term. When I say short term, I don't mean short because that's not good either. That's speculating, and we don't do that. It's high risk. But short is in 4 years, 5 years, and I'll show you how you know where the growth cycles flatten out. I'll show you that. So we take all of this about the research. We know the areas. Then we match this to a specific client. No two clients are the same. So if ever someone says, can you just, send me 2 or 3 of the options that you have right now? The answer is never going to be, I'm going to email you 2 or 3 options until I really understand what you're trying to achieve. So that's why the very first thing, the very first quadrant, if you can see my mouse moving here, when we meet for the first time, if you were interested in investing, I would want to understand your goals. So I would say to you, why do you want to buy an investment property? What's the objective? People say, to make money. Okay, great. So let's say you did make 100,000 or whatever it may be. What do you want to do with that money? And that's the really important question. Is it to pay debt off on your own home? Is it to put into retirement savings? Is it to have money for private school fees? What is the goal? Because what we're doing with property is nothing more than using it as a tool to create wealth, and that is the goal. So that's how we see it. To acquire property for no purpose except to hold property. If you're strategic with property, you can really create very good wealth. Then we also want to understand a customer's capacity. We want to educate them on the market like I'm going to do tonight in this webinar. Then once we understand this, we will leave there and know. So maybe the client situation is from one client to the next is very different. So someone can actually manage to have a house and land package, for example, that's got a construction loan and progress payments before you get any rent, like over 6 months or so, versus someone who cannot actually do that. They need a single contract, pay nothing except for the 10% until the property settles. Then they need a different property option. And depending on a client's capacity, which we determine in meeting 1, we've got to offer them a property at the right price point to make sure that you can absolutely afford it, you can settle on it, and you can really be okay no matter what happens with the interest rates. All our properties are cash flow positive, by the way. But when interest rates change, it does change the financial money in and out. So we need to know all those things. So once we know that, the second meeting, we'd come and present an option. If the client liked it, right now we'd say get on a plane, fly to wherever it is, Brisbane or Maroochydore. I'll be there. I'll hire a car. I'll pick you up in the car and I'll take you on about a 3-hour tour of the property option that you like, that you're thinking of purchasing, to show you what's on the left side there on the screen, to show you all the infrastructure changes, to show you other comparable properties that compete with the one that you're looking at. So you are excited when you leave there knowing in that area, I absolutely have the best townhouse, or I know that my house in this area, if anyone comes to look to rent it or in a few years' time to buy it, that this is really the preferred option, or at least one of the preferred options out there. Then once you've come back from the trip, if you're happy to go ahead, you carry on, and we just help you with the implementation of purchasing this property. This is something we don't do ourselves, but we've been in the business for a long time, so we can, if you don't have a conveyancing attorney, we can refer you one that's Queensland registered. When it comes to handovers, we can recommend that. If it's come to depreciation schedules, we get a special discount for our clients through BMT for depreciation. A really good price. You save about 50%, to be honest, because we give them all our business, so we get good deals from them. If you need a managing agent, we do that. We find your managing agent. We manage the managing agent, because if we are looking at area X, we're not going to put just one client in there. We'll probably put 5, 10, sometimes 20, sometimes more than that. So that agent will take all our properties and manage them for all our clients. So we want to make sure that every single client has a very good experience and no problems. So we very selective with who we choose as a managing agent, even before we decide to select those properties to put in front of clients. So if you ever had a problem once you bought something from us and your managing agent didn't help you, you'd call me and we'd fix it up straight away. And if it wasn't resolved properly or the agent did have some kind of issue, then they stand much more risk, because you wouldn't just take your business away from them, you would take all the clients in that area away from them. So we never had a situation like that. We have very good managing agents, but I'm just letting you know that the service is because we have bigger buying power or negotiating power. So then you'd go ahead with everything, we'd help you along the way. This is the most important quadrant. We review your plan in line with your goals and stay in touch with you. So we actually review your portfolio ongoing. We will send you an update at least once a year. In other words, the growth is still very strong. This is happening with the infrastructure changes. This is new. Keep holding the property. We still got, we see good growth ahead for, I don't know how long, but we'll mention that. And eventually will come a time when we say, okay, we believe that we've reached the crest of the growth curve, and we recommend that you sell the property, and this is the next growth area. Now, if anybody wonders why sell, why would we recommend that? And I'm laughing a little bit because I was a buy and hold forever person. And when I met Mike, he was talking about selling the property. I hadn't even bought it yet. And he was talking about, oh, you'll sell it in 5 years' time or something. And I didn't understand that, because my parents taught me to never sell investment property, hold it forever. And they said that because my grandfather said, never sell investment property, hold it forever. I just have to tell you, to be honest, it's old school thinking, and I'm going to show you why. The property market grows, let's say approximately 8% year on year over 100 years, but it doesn't grow in a straight line. Okay? It's got these short, sharp upswings in growth, followed by a long period of stagnation. So if I can give you an example, if anyone knows the Sydney market between the year 2000 and 2003, there was significant growth in Sydney. And then Sydney was stagnant for 10 years. People forget that. They say, oh, I made so much money in my property, that I sold in 2015. When did you buy it? I bought it in 2004. Well, your property did nothing between 2004 and 2012. Nothing. It stayed the same. It only grew from about 2012 and then shot up significantly. So in these periods of stagnation, what's important to know is when one property plateaus out, another market is taking off. And after a few years, when that one plateaus out, a different market is taking off. So if you are strategic with your property purchases and the timing of buying and selling them according to research, you can be very effective in creating wealth through property. Now, this is theory. I'll show this to you in practice. These are actual numbers. In the year 2000, we were putting clients into Sydney. Sydney grew significantly between 2000 and 2003. When it came to 2003, we told our clients, sell the investment property, pay the capital gains tax, pay the agent's commission, and get into the new market, which is Perth. As you can see, it's slightly at a lower point there, because that's exit and entry costs. You also pay conveyancing fees, stamp duty and legal fees to get into the new property, and capital gains tax and agent's commission on the selling of the old property. So you pay all that, and the price was slightly lower. But when you get into a growth market, you make that money back in 6 months, maybe 8 months. And then the prices shoot off again. After a couple of years, we said clients, hey, according to the research, sell Perth. The next growth market is Darwin. Again, the price point is slightly lower. Paid exit and entry costs, stamp duty and legal on the new one. Again, 6 months later, 8 months later, you've made that money back and the market shoots off. After a couple of years, let's go to Melbourne. Same thing. I'm very happy that the Melbourne lines are not perfect, because life is like that and doesn't happen that way. But still, Melbourne did really well. When we came to 2012, we could see that the Sydney market was now, after a stagnant 10 years, was going to just take off. We told our clients at that stage, sell everything you have in wherever it is and put all your proceeds into Sydney. Now, the price point here, if you look at the chart, is at a 1.1 million. I want to make it very clear. We never sold anybody a property of 1.1 million in Sydney in 2012. We probably sold them either 2 properties at around the 500 mark each, or 3 small townhouses around the 300 mark each, 350, 370, somewhere there. We're not in this, the upper echelon of the wealthy up there. We're in the big market where there's mass demand, but we're not at the lower socioeconomic by any means, because there's problems with tenancy and tenants when you're down there. So we were looking in areas in Sydney like the Ponds, Edmondson Park, Rudy Hill. I'll show you some towards the back end of the presentation. And then you can see that Sydney took off. Now, why we say buy and sell is a better financial strategy than a buying and hold when it comes to property is if you're a buy and hold, this is what would have happened to you over 15 years. You would have held that property, and that's exactly what the price point was at that year. If you did the buy and sell strategy, the difference between the two is $880,000 better off in 15 years from one. And I can tell you, most clients after one, by the second purchase, are buying 2. After this purchase, they're buying probably 2 here. After this purchase, they could probably buy 3. So this is very conservative. It's saying on one property over 15 years, if you had an exit strategy, you're better off. I personally want to admit that I argued with Mike when I was his client back in 2012, 13, those years, and he said to me, sell, and I said, I'm not going to sell it. He goes, Jeanine, you make more money if you get your money out of Sydney and put it, this is like in 2015, put it into Brisbane. And I thought, no. And he said, come, I'll show you the numbers. And he sat down with a pen and paper, and he took me through the actual numbers, and he does it himself with his own investments. So I now am a convert, and I also offloaded my New South Wales properties. I've put all my investments into the growth market. And just because you put I've got several in Queensland, it doesn't mean all my eggs are all in one basket, because the market in Queensland, where we are, is completely diversified. If you bought a property in Springfield, that economy, that market is completely different to something in North Lakes, which is completely different, the different economy to something in Sunshine Coast. So we wouldn't say to a client, buy 3 in this development. We would say buy 1 on the southwest of Brisbane, 1 on the northern precinct if you're buying 3, let's say, 1 in Sunshine Coast here, 1 is a house, 1 is a townhouse. So you diversify your assets, but we take them out of a stagnant market. I hope that makes sense. If you have any questions, you can let me know. All right, now let's have a look what's going on with the actual market as such. So in the COVID year, this is 2020.
Excuse me, Jeanine, I have a question.
Yes, please.
Okay, so I got divorced 2 years ago, okay, and we had to sell the property. I had 2 properties, and I didn't end up with much left over. She took most of the finances, but I've held on to that money and haven't bought anything as yet. I'm just renting at the moment because I was worried about the market with the COVID. They said it was going to crash, and I'm from Rudy Hill. You mentioned Rudy Hill before.
Yeah.
And now I'm in a position to buy, and I've been advised by a friend of mine to buy at Coffs Harbour, and he reckons it's there's a lot of infrastructure there, and they're building roads and everything. What you said, he reckons it's going to be like the next Byron Bay, but I haven't actually got a house to live in on my own. I'm only renting, so I'm not sure. Like, should I, buy in a good place to invest and continue to rent, or should I have my own property for myself and my kids first? That's what.
All right.
What to do?
I love your question, and I'll use myself as an example. And I'm not saying this is the only answer. It's personal, and a person can do what suits them. I have been in Australia for 10 years. I have several investment properties. I rent. But I rent on purpose, Jamie. I rent because, let's just say you had no property, none at all, and you had capacity. I'm going to make easy numbers. You had capacity to spend 800,000. Okay. If you went to the bank and took 800,000 and bought yourself your own property, That's it. You've got no more capacity. You cannot buy anything else. You cannot buy an investment property until you, one, have saved at least 70,000 for the cheapest property to be able to get in. Okay, if it's very conservative, 55 or at least or more to buy an investment property, and you need to have capacity, which means your income needs to go up. So once you've spent the 800 on your own, you can't borrow anymore. If, however, with 800,000, you bought an investment property, you can go back to the bank and probably buy a second investment property, because when you buy an investment property, you get an income stream as well. You're also buying an income stream. You're basically buying a rental income. That rental income, if it's 20,000 or 30,000 a year, gets added to your salary, and your borrowing capacity goes up.
Yeah.
So then you can buy another one. Now, let's say you only did that for the first 5 years. If this is what I did. For the first 5 years, I bought 2 investment properties. The one made 180,000. The other one made 340,000. That's $500,000. Now you've got $500,000. At this stage, you can choose. Do you want to buy your own house and put down a decent deposit of $500,000? Or do you want to put them back into the market and maybe buy 3 investment properties? We don't want loans right up to our neck, so we can put nice deposits down or offset accounts. And then do it again, make another 150,000 on the next 3 properties, which means after that, you'll have another 500,000, let's say. You now have $1 million 10 years later, and I'm just being conservative. Now you've got $1 million. That's a personal choice. For me, the reason I still rent is there is no way with my financial education over my life, and I started doing financial courses at 20 years of age, and I understand debt, good debt and bad debt, and a mortgage on your own house is bad debt. So I would only buy a property in Sydney if I could put a huge deposit down and be able to pay that debt off in a few years. But I certainly ain't buying a house with a 30-year mortgage of 800 million, 1.5 million. Good luck. I don't know how a person pays it off. Unless you can.
Even with the rents, even with the house I'm renting at the moment, I got it very cheap. Like I said, I got it in 2020, and was at the time where I couldn't even go inside to view the home. You had to view it by video, okay, when they were strict with the lockdowns. But I knew the house, what I was getting. I knew someone who used to previously lived here, so I took it. I'm only paying $380 a week. It's very cheap.
Gee, that's great.
It is. But they're knocking it down at the end of the year. Now, I've started looking at other places to rent, because that's what I thought, rent where I want to live and, buy where I want to invest. But, the rents now, you're looking, $700 a week. And, I went to one a couple of days ago, and the lineup, there was about 80 people there to apply for. And I'm thinking, what am I going to do? Am I, I really do want to invest in good areas. Like my mate has just joined a sort of thing like what you guys are doing, and he's building in WA at the moment, a home and land package. But I'm looking for somewhere to live, and just a little bit worried about it. I know I can actually.
No, look, you will find a place to rent, and if you want a very good agent in Rudy Hill, I can recommend Roy Amory from R&W.
I know him. Yeah, I do know. Yeah,
okay.
yeah.
Solid guy.
David Friendo, good mate of mine.
David Friendo, excellent people. I recommend them any day of the week.
Yeah.
You will find a rental property. The other reason that this is a personal thing for me, I'm not recommending this to anyone, that I'm still renting, is if you bought a place in Sydney, your stamp duty is at least 50,000 or more. So if you paid that much just to get in the property and you didn't like it or didn't suit you, or you were too close to something noisy and something wasn't right, and you couldn't know that, because the pressure to buy property in Australia is like, you got to go see it, you got to make a decision, put in the offer, because otherwise it's gone, kind of thing. You'll be reluctant to move because you've just spent all that money on stamp duty. If you're renting, you can move, I don't know, as often as you like. It doesn't cost you anything except the moving.
Yeah, 100%.
So I would always recommend a person rents in the area before they live, just to make sure you don't waste that. But that's a personal choice. Some people are conditioned or programmed in the way that they only feel secure if they own their own property. I'm not like that. I just want to live where I love to live. And people think you're throwing money down the drain. Well, I question that, and I'll say, how much do you pay on your mortgage in a year? Anybody. And if you're just paying your repayments, you're probably paying 2,000 to 3,000 only off the mortgage principal. The rest is interest. So whether you're paying it to the bank or you're paying it to a landlord, live wherever you want and make 150,000 in 3 or 4 years in investment property, and do it again and do it again and build yourself wealth. That's my strategy. It's called rent vesting, and that is my strategy, and I'm very happy with it. And I probably will buy my own place at some stage, but when I do, I'd like to put down a significant deposit or pay it outright, because debt on your own home is bad debt. And if you did buy with a big deposit, you can immediately use that equity in your home to get back into investing straight away on the same month that you bought your own home. Use that equity, get something else invested. So after a couple of years, you can sell the investment property and take that profit and pay the mortgage down again on your own home by a couple of 100,000 and do it again until you've got no debt.
So even like I have got a half decent deposit, okay, you still think to invest rather than, like, I'm agreeing with what you're saying. That's why
my suggestion, Jamie, would be, I wouldn't be able to answer that on this webinar. I'd catch up with you to understand better everything in your situation. Yeah.
Okay.
All right. So let's carry on.
Thank you.
Pleasure. So if you look at 2020 with COVID, it's extraordinary how many people left New South Wales, how many people left Victoria. This is a like a record number. And all of them went where? Queensland. So Queensland, starting in 2020, so when COVID hit in March, property went quiet. And by about July, people said, let's get back into investing. They didn't go on holiday. They didn't travel. Some people got a bit cashed up because they were just doing nothing. And once it started, by the end of 2020, November, October, November, it was getting really busy. And it's been significantly busy since then. This has created, I'm going to use the word chronic because I'm genuine. It's a chronic shortage of property in Queensland. People cannot find a place to stay. On an open day with a townhouse, 2-bedroom townhouse, 50 people go through the open home. Applications all over the place. People were offering 6 months, some people 12 months rent up front, saying, I have to have a place to stay. So this caused a chronic shortage. So if you want to understand how the prices of properties move, and they move via state for state, if you look at this interstate migration chart, the blue and green line are mirror images, and WA and Victoria are mirror images. So there's an interrelationship there. So what I mean is, when I said to you property prices went up in New South Wales between 2000 and 2003, people left because the prices were getting too expensive. Where did they go? They went into Queensland. After a couple of years, the Queensland prices started to shoot up, so people left. They came back into Sydney. Now you jump forward here to this year or on, and we're seeing the same thing happen again. There's an outflux of people from New South Wales, and where are they going? They're going into Queensland. You just saw that here. There. Okay? And the reason they would move to Queensland is, at this stage, prices in Queensland were 40% of the price of what they were in Sydney. So affordability was everything. And then when it comes back to the pinch point, the prices came close together again. They were about 80% of what they were in New South Wales. So looking at this chart, we can estimate as this expands, it's going to create the same pattern again. As prices go up and up and up in Queensland, people will move back, and then the cycle will happen like it did before. So with 30,000 people moving in 2020, and we reckon, we didn't have the stats, I don't have them in this presentation, how many people moved in 2021. There's just, all I can say is a chronic shortage. Now, this article says Queensland population to explode by 250,000. That is bigger, that is more than double anyone's highest expectations. And if that happens, I can't tell you how on earth they would be able to provide homes for this many people. So that's yet to be explained. But what does this mean for you from an investment point of view? This means it's an excellent investment market, because what drives price? Supply and demand. Look at the demand. And the supply is already so short. Now, if I can tell you, if we get a house and land from a developer, we put it in front of a client, we need the expression of interest on the same day. If we don't put that towards the developer, they will sell it 5 times over in an hour in the local market. So we, for the first time in years, Mike said in 25 years, he's never seen a market like this. So high in demand. We are begging, if I can say, or really waiting with developers to get stock because they're selling it to the local people. And why are they buying? They've got all these incentives from the government. So we really are competing with them. So for the investors, they are really squeezed out the market and there's not much available. But if you can get a property, tenancies through the roof as well, because of the shortage, we have leases signed and in place and have had for 2 years now on every single property that settles. There's a lease in place before it settles because people are desperate for a place to stay. Rents have continuously moved up as well. So it's a really good investment market. And I'll just show you, there's another article on the right-hand side here, which is the same thing, saying that 250,000 will move there. So look at the COVID property market just quickly. The impact of that interstate migration has caused critical shortages of rental properties. Also land for house and land packages have also extremely short across southeast Queensland. And as I said, the incentives for the owner occupiers from the government, whether it's first home owner grants, stamp duty exemptions, things like that. I don't know what they are exactly now, but there's a stage where you'd save 35,000 with your incentives. That's a lot of money. As for landlords, excellent market. Rents have continuously moved. There's a big difference here, guys, between when we were, so the market before Queensland that we were in and helping clients was Sydney. We were putting clients into Sydney from 2009 to 2015. Okay, from 2015, the end of the year, we started to focus on Queensland. That was the next growth market. In all those years that the market in Sydney grew like crazy in price, rents never moved. Here in Queensland, from the very beginning, rents have continuously moved up. In a 1-bedroom townhouse, just 1 bedroom, in 1 year, the rent moved from 320 to 340 to 355 to 380 to 400. It's now at 420, and I expect the next lease will be 440. So we haven't experienced that. So that's what we say here when rents are up 5 to 20% year on year. So prices of the properties themselves are going up all the time. And even though there's such a shortage now, so we only do new because we want the maximum tax deductions to be highly tax effective and have the most tax back at the end of each year to be the highest cash flow positive because of the tax back. We only sell new. And the reason you're the most tax effective is, I don't know if you know this, but in 2017, legislation changed and depreciation on fixtures and fittings is 0 on a second-hand property, even if it's only 6 months old. You only get depreciation on the building. Now, depreciation on a new property is half. So on a $400,000 townhouse, 7,000 is fixtures and fittings and 7,000 the building. So if you buy 6 months old, still new, you only get deductions on half of that, on 7,000, not 15. So even though with new properties now, there's a longer delay to settlement because we're getting them so early. The minute they're available, they are sold. Then they have to wait for land to register, whatever things will get to go on site and build them. There might be a delay to settlement, especially on house and land packages. I sold one last night. The land only registers in November. But you know what? Better in than out. If the client didn't put the EOI in, it would have been sold by the developer today. He did it last night. At least he's in the market because come November, none of that will be available. So we see this shortage, moving throughout the supply chain, also affecting construction costs and things like that, which I'll talk about. So when we say better in than out, meaning some people had, that I've spoken to across all clients, a kind of reluctance to buy off the plan because the property either only completes end of this year, some only complete the end of next year. But if it's a townhouse and you put down the deposit into a trust fund, so if anything goes wrong, you get the money back, you don't pay anything the whole time they're building it. When it's settled, it's worth more than you paid now. At least you've got a property that's continuously appreciating. Because if you try and buy something that's ready, I would question, if it's new, why is it not sold? That would be a question mark in my head, because good stock goes the minute that it's launched. Okay, and then the types of property and price points, we got townhouses between the 350 and 770 range, some are even 850. We've got more than higher than that as well for specific clients depending on their situation, but that's the average of the majority of what we're doing. House and land packages start in the upper 500s, go up to 820, and all rentals on all our properties, they're rental guarantees. There's no cash flow risk. I can tell you there will never be even a need to use the rental guarantee because there's such a shortage of stock. As I said, we get leases signed even before they settle. We also offer sophisticated investors another option. If you're interested, speak to me separately, please, about development equity and mezzanine debt funding. We do that for specific clients, small projects. All our investments are cash flow positive, every single one of them. We don't see any point in buying an investment property and having a cash flow drain. It doesn't make any sense. So you're buying an investment to put money in your pocket. So they must put money in your pocket whilst holding them. But the absolute goal is to make big chunks of money every 3 to 5 or 6 years when you offload that property and create wealth. So cash flow is a bonus. It's not the focus. The focus is big chunks of cash. Because even if someone said, oh, I've got this very old property with a very high rental yield. Okay, how much is high? 10,000 a year? More than something else? Well, 10,000 a year over 5 years is 50,000. If you bought a really good property that had capital growth, not an old one, and you could sell it for a really good price in the right area, you'd make 150,000 in 5 years. So what is 50,000 in good rent when you could make 150,000 capital growth? So cash flow must be positive in our view, but it's a bonus. We're actually focusing on capital growth. And then let's look at the property post-COVID. So right now, the narrative out there is negative. It's in the media, it's in the press. Just be aware, guys, what they put in the media. I don't even have it in this presentation, but just go and find one of my old property presentations during the beginning of COVID and watch it. I've got headlines in there. I just post like 10 headlines. In 2021, at the end of 2021, I showed what they posted at the end of 2020, a year ago. They said that the house market is going to crash, property prices are going to fall 85%, people are going to be prisoners in their own home because of debt and things like that. None of that happened. So just be aware of what the media says and what's actually going on. So they're driving a lot of fear right now. Interest rates are going up. They have had builders collapse. It is true. Things like Condev have gone bust. Impact Homes have gone bust. Metricon. So that is true. Those are construction companies. We deal with developers. It's a different thing. And they say the market looks shaky, don't invest. Well, some of these issues are true. If you look at them, they are true. But when you break them down, which I will do now for you, there's not that much fear. The interest rates are, even though they're going up, they're really, really low. They're still low. Look at this from the year 2000, the interest rates where they were. So if you compare that, when we placed clients into investments around 2015, the interest rates then were 5%. Also, interest rates that go up mean that you get higher tax deductions because your interest on your investment property loan is tax deductible. So that goes up, you get bigger deductions. It also reinforces the reason to buy new properties. As I said, the depreciation on secondhand is much, much less. So new properties boost your depreciation and boost your cash flow. And all our projects are cash flow positive. So with all the fear mongering, what really is the problem if you've got high demand for someone to tenant your property. Prices are climbing all the time. No matter what interest rates do, you're still cash flow positive. Then you've got to put the news and the fear into context. If you're talking about New South Wales, yes, I foresee a bit of a problem coming as interest rates move up, because a lot of people bought when the interest rates were so low, up to their neck in debt. And when that interest rate moves a couple of percent, many people won't be able to afford their homes, and there's going to be probably a lot of property on the market, higher competition, driving prices down. That's what I see coming. So for any of you, like Jamie spoke earlier, if you're looking to buy your own property, I'll just wait until interest rates move more and more. You'll probably find better deals than you do today. So that's just estimating. Builder liquidity risk. So there were, as I mentioned, those construction companies have gone belly up. And the concern is not new. Sorry? So someone asked for something? No? The concern is not new contracts, because the cost increases have been factored in. So the contracts that we're putting in front of clients, we know where we stand. We know how much the price is. Everything's gone up. Trusses have gone up. Steel's gone up. All the building materials have gone up. So there were, like on paragraph 3, we've seen developers seek additional funding. Once a contract was signed, they came back and said, you can cancel the contract, get your deposit back, or if you want to continue with it, the prices moved up and pay the extra, I don't know, whatever thousands. That they did ask, it has happened, but actually it happened to some of our clients on townhouses and apartments in certain areas. We prefer that than the developer not saying anything, trying to absorb the cost increases and go bust. If the developer goes bust, no one gets what they want, and it's a big mess. So what ours did, if a client bought, for example, a townhouse that cost at that stage, let's say 350,000, they said the contracts are all going to be cancelled and reissued. If you want to still keep the property, it's now 385. You must sign a deed of variation. If you don't want to pay 385, then we give you all your deposit back, every cent. You lose nothing, and we'll sell it to someone else. So no one would lose anything. And some clients were upset. And I said, you might be upset about them changing the price, but you'd rather have that and get the investment property you want. And all of them that did move the price during that phase, the properties were still worth more than what they moved the price to. They just moved the price to cover escalating increase in cost of building materials. So we don't expect much of that to happen anymore. I'm just letting you know that it has happened. And now some developers are advertising like we guarantee the fixed cost is like a marketing thing because of what's happened. None of our developers went under. They are all carefully selected. We don't really work with public companies. We generally work with family-owned businesses that have been around for many years, several of them 40 years in business. So they're well established. They've got good financial stability, and they really know what they're doing. Also, to remember, yeah.
What's the sort of average time like for these houses from start to finish?
So generally, it depends on the developer, but generally a house is built in 6 months. With the delays in materials, we had some delays. Some houses took 8 months, 9 months. But the developer would have never known at that stage that he wouldn't be able to get wood, or he wouldn't be able to get metal. So it was just a circumstance. Now we know where we are because we've gone through most of those shortages already, and we can estimate properly and deal with developers who are on time. So if there was anyone who did that and caused delays, we would think twice about taking properties from them, even though we need them, because if there is going to be any delay, we would be able to inform our clients. So we'd rather have a transparent, open conversation about what's happening than put people through shock. We also got the shock when the shortages started. I don't know if any of you know, but if you just Google it, you'll see the prices of building materials has gone up. So yeah, 6 months I'd say, but with the townhouse, it can be 12 months. Depends on the development. What's that?
I said I've got and upholstery business, and yeah, I understand. Everything's going up: fabrics, foams, wood. Yeah, it's going up significantly. So yeah.
Yeah, thank you. And then also remember that when you're buying off the plan, you're not risking that deposit that you're putting down. If anything did happen, let's just say we didn't have any developer go bust, but if something did happen, that deposit is not held by the developer and it's not held by us. It's held at a solicitor's trust account. And if anything happens, you get your deposit back. So it's not at risk.
So even if they go bust, even if the company goes bust,
yep,
you'll still get your deposit back, will you?
Yep.
Okay.
Yep. And oops.
And that's all guaranteed, is it? Like in the contract?
That's in your contract. Then you look at the property market. So markets with high levels of debt will be spooked. So we're talking about here in Sydney, Victoria, Melbourne, things like that. Markets with low rental yields, like Sydney, Melbourne, they'll also be spooked, particularly when combining with the rising cost of living. So I'll just say even if someone asked us for an investment property in Sydney or Melbourne, we wouldn't do it. We'd have developers giving us properties any day. We wouldn't do it. It's not a good investment right now. As people need to seek more affordable places, it definitely plays into the hands of Southeast Queensland, driving demand up and rents also going up and the values of the properties going up. So there's a big reason for people moving down to Queensland: affordability, affordability, affordability. Think of a retiree in Sydney who's got a $2 million house paid off, even a $1 million house paid off. He can sell that, buy a 4-bedroom house in Queensland, and put $500,000 into his retirement savings. So from an affordability point of view, you can understand why so many people are moving interstate there. So exit strategies. So these times allow us to implement the exit point of our strategy. Right now, where we actually are helping clients at this very moment to sell their current investments that have had significant capital gain. So we've had clients we started putting into certain suburbs like Heathwood, for example, in 2016. They've already made over 300,000 on those properties, and they've taken the maximum of that growth. We're now looking at other areas in slightly different places where there's still a further upswing in growth. So they're better off selling that, taking all the profit, putting into the next area that's got more upswing in growth and make further profit on that than just holding it. So we're helping them. And that's really important in a time of rising interest rates, because you take the profit, you can put it into your own home if you've got debt, reduce that debt, use the equity, get into the new investment property. So if you do have debt on your own home and you have equity in your own home and you're not using it, I really would advise that you have a conversation with your accountant, your mortgage broker, myself, someone, because you are not being most effective with your resources. It doesn't make any sense to have equity in your own home and debt on your own home still and not use that equity to buy an investment property to make profit, to help take it out of the market in 3 or 4 years and put a few $100,000 into your own mortgage and bring that down, because that's just the biggest waste of money. The interest on your own mortgage is horrendous. If you know what you pay over the term of your loan compared to the price of the house you paid when you signed for it, it's more than double by a long shot. So very good to bring the debt down on your own home. Also, to bring the debt down, this also allows for reinvestment into new tax-effective growth assets. That's what we said, and happy clients. The drivers of growth are supply. Let's look at supply and demand, okay? We want to know the current supply of property and the future supply of property. This helps us know when prices are going to stay going up, when they're going to start coming down. So that's why we knew Sydney was going to plateau when it did. There were apartments being built everywhere in Sydney. Every suburb had apartments going up like crazy. That caused an oversupply. So that's an example. Population growth. I showed you the interstate migration chart. Rental returns is a very good indicator. If the rental returns are moving, we know prices are still going to move. We know when rents stop moving and property prices move high and high, they get to a point where there's that big gap. and then you know it's reached the peak of the market. If rents are closer to $1 per thousand, you know there's still room for growth. So that's an indicator. Affordability is a big driver of growth because people move into the area, which is happening right now, and demographics, as I mentioned earlier. Okay, here's the same chart. If you take that chart and look at this one, going back to the year 2000 to 2003 when Sydney grew, you can see the price of Sydney lifted away from the average median price of Brisbane. And then as Brisbane prices moved up, I said Sydney was flat for 10 years. They'd created this pinch point. Let me just move this across. So now where we are over here, there's this big gap. So you can estimate that this big gap is going to repeat the cycle and create a pinch point. And that's when the prices Queensland rise, because they're very affordable now, until they're closer to what Sydney prices are. And then that market will be peaked and going to cool down. This is an older chart, but the thing's exactly as valid as they were now. Then the worst rental yields in the country are Sydney and Melbourne compared to the price of the property. So yield is your annual rent divided by the price of the property as a percentage. So not very good for investing is a low yield. Very good for investing is a high yield. And as you can see, Brisbane, the highest rental yield, and Sunshine Coast, excellent. We're not putting clients into Gold Coast. I'm just mentioning this. We don't think it's a good investment compared to Sunshine Coast or Brisbane because employment isn't as strong there. So we can sell. There's tons of developers there. We're not putting clients into that area. If you look at the Sydney median house price, more or less around 1.4. Brisbane, it was 550 just a few years ago. I kept changing the slide. It's now around 790. But besides that, the household income is almost exactly the same, maybe 7%, 8% different between Sydney and Brisbane. But the price of the property is significantly different, as in the median house price. So this means affordability. How many times your income? 9 times versus 5. That's why people want to live in Queensland, because you're paying for a beautiful big home, a fraction of what you're paying in Sydney, and your lifestyle is better because you've got more disposable income. This is just looking at demographics, the last 10 years in blue and the next 10 years in yellow. And you can see the biggest group is downsizers. That's really important for us as investors. People wanting a townhouse or a house and land with a small garden. They don't want an acre of lawn to mow and all that maintenance. What they want is a park nearby, nice facilities, transport close by, shops, all the amenities, you know, something nice either in nature or the beach or the sea or something. So they want to downsize. So someone coming from Sydney into a 4-bedroom house in Brisbane is still downsizing. They come from a 6-bedroom house here maybe. And the other big group is young renters, which is great for us because as investors, that's what you want. Thanks for your email address there. So let's look at Sunshine Coast, just a quick top of the waves numbers. Look at the population in 2017, where they're estimated to be in 2040. That's massive growth. Look at the number of schools, 135 to 205. The airport in Maroochydore is becoming an international airport. That's a massive game changer. The number of dwellings growth. Population. Look at the retiree numbers. So retirees are a group for us. We've got some developments where we've got retirees who bought. Here we have just versus the Australian average population growth in Sunshine Coast, 58% versus 38% in Australia. It's way outgrowing the average of the country. Look at the labor force growth. This is important. When I said where jobs are, demand for property, constraint and supply, prices go up. Identifying the areas of greatest opportunity. So in summary, Brisbane and Sunshine Coast are currently our preferred markets. They're the most affordable of the large capital cities. They've got strong yields, low vacancy rates. The vacancy rates are like under 1%. They're like 0.5%. The balanced market's 3%. Everywhere we are, the vacancy is low, like really low. Changing infrastructure that leads to employment growth, which we want. And the demographic points to infill townhouses and nice house and land packages. We've done very, very few apartments in very, very select areas. So we're not looking at Brisbane CBD, and I don't recommend anyone buy in Brisbane CBD or within the first like 10, 12 kilometer ring around it, because your rental yield is nowhere as good as the areas where the blue stars are. We're talking about a 30-kilometer ring around. We also don't go too far southwest. Ipswich way, again, employment is not as strong as the areas where we are in, and that higher demand for property, better capital gains. And down here and more south, no. So we are around here, the coast. We're down here near that Springfield area. Other suburbs around here, Pollara, things like that. And
Sunshine, I feel like you've got Sunshine Coast in completely the wrong spot.
Sunshine Coast is not on this map.
You've got, it says Sunshine Coast in the big blue star.
No, this is not Sunshine Coast. Sunshine Coast is off the
Can
map.
you see the blue star with Sunshine Coast in it? Down the bottom right.
I don't know why that says that, sorry. Thank you for alerting me. Whoops. Let me just fix that.
I was confused for a moment.
Yeah, there's definitely... How did that happen? It's someone else. I should just delete that star. Copy, control, paste. Whoops. Thank you for letting me know that.
It's all right.
No, I've messed this up.
Oh, well,
Sorry,
sorry
guys.
about that.
It's okay. Let's just move that out. Bring this back. And that's around Thornlands area, somewhere there. That's more correct. Yeah, thank you.
Okay.
Yeah, no, Sunshine Coast is way up north, far more north than this blue star right up there. Sorry, that's the Sunshine Coast label. Can you see it there?
Yes.
I don't know how it landed up where it was. So Sunshine Coast, there's far north precinct here, certain areas, even up around Joyner. We're doing something there at the moment. We've done quite a few areas around here, and even as north as North Lakes and Narangba, places like that now as well. All right, so the options are house and land packages. We do townhouses off the plan and very specialty apartments only, very selective, because there's an oversupply of apartments and they're not a good investment in any capital city. Thank you very much for your email addresses. Positive cash flow options is a quick top of the waves. This is house and land. The price is approximately 615,000 to 800,000. 4 bedrooms, 2 living areas. Big houses of about 200 square meters. You're getting about $710 a week in the example I'm going to show you. And positive cash flow per week after tax is $180 positive cash flow. So here's an example in Joyner. Why we like these is literally up the road. The price of the same size house is in the 800 and up, which is in Warner. And if you look on a map, Warner and Joyner, they're right next to each other. So this has got good potential. These are terraced homes. So that's the style there. That's what they look like. Good finishes, stainless steel appliances, air conditioning, ducted aircon in most of our properties. Otherwise, you've got aircon in split systems, but ducted in a 4-bedroom house. And it's total turnkey. Here's another area, completely different, southwest, just beyond Springfield near Red Bank Plains, called Eden's Crossing. In the upper 500s here. Also a big house, same size, and the cash flow is about $150 a week positive cash flow. As for townhouses, this is Brisbane. I'm going to show you a very upmarket townhouse. They're not all this price. They're often less than this, but this is very, very schmick appliances. And as a 3-bedroom, they are bigger than a 4-bedroom house. The cash flow is 100 per week, rent's about 650. It's McDowell. So you can just tell this is an actually what it looks like. You open the entire lounge. It's beautiful. The house is very, very oversized. As I said, bigger than a 4-bedroom house in square meters, and it's a 3-bedroom. So that's McDowell. Then Sunshine Coast, fantastic investment market. This big university hospital is the biggest in the Southern Hemisphere, and it's not even at capacity yet. It's new. It's got employing about 4,500 people. Its capacity 6,000 people. This has changed the game. And in the area that this is located, the entire precinct is a new medical precinct. There's lots of new jobs there, and big driver of growth. And then the airport expansion, being an international airport, is going to change the game as well. Maroochydore, so much infrastructure development and change in Maroochydore. There was a golf course in the town. That's now an entire business area, business district, new buildings of companies everywhere. The light rail project is going to change the game there as well, connecting the most popular 4 points with a little light rail. Then they already had an existing shopping center called Sunshine Plaza. It was already big and beautiful. They've made an expansion. They actually spent 400 million, more than that. It's beautiful. All the restaurants up above, looking down on the little boats that you can paddle down below. Very beautiful. Big shopping center. All the brands, great. The upgrade to this Kawana shopping center, a theme park coming. The Sunshine Coast has quite a bit going on. Yes, Anita. You're on mute. You're on mute, Anita. I can't unmute you, only yourself.
Sorry, I'm not meant to have my hand up. I don't know how that happened.
Oh, okay. Lower
Ignore.
Hand. There we go. And then these townhouses in Sunshine Coast, absolutely fantastic investment. The price level around 440 to 540. We're not sure exactly because the next stage hasn't been released. I don't know what the price will be. But they're 2-bedroom or 1-bedroom. And people thought, oh, that's a strange size. Why don't you make them 3-bedroom? Because they're near the hospital and there is a chronic shortage of 1-bedders and 2-bedders. So the developer, DevCon, did some research, and there's also a KPMG research report, if anybody wants it, I'm happy to share it with you, that talks about the shortage of 1-bedroom. So they said, let's take a chance and build a development, which they did in 2018, called Ascent. And we sold those at that stage to clients. They are a great investment. They've all appreciated over 100,000 already in just that short time. The rents have gone up over that short time. They're still $1 per thousand or higher than $1 per thousand as the rental yield. So they did another development in the other side of Sunshine Coast towards Butterham, and this is what we have now. So this is the 2-bedroom, beautiful open staircase. I mean, they don't have to open the staircase. It's cheaper to close it and put carpet on it. But they've got nice wood. It looks very open, double story. The upstairs has got double volume ceilings with skylights, very spacious. It stands out. If anyone's looking for a 2-bedroom and they go to something else and they come to this, there's no way you won't want to stay here. It's really beautiful, and the finishes are great. Oops, I can't see my heading. Sorry, my toolbar is, and I can't move it. Sorry, guys. I don't know what it says there. Something Sunshine Coast. I'm trying to move there we go. Oh, townhouse, Sunshine Coast. Okay, this is an example of the 1-bedroom in that area. It's in Butterham. It's about 440,000. The rental level is 420 at least, probably around 440. Look at this cash flow for a 1-bed, $110 per week. It's 5 minutes away from this building, which is already sold. We've sold it. I'm only showing it to you because this is in Sippy Downs, and the townhouses that I showed you are 5 minutes away from Sippy Downs, because we chose that area because Sippy Downs was rezoned and there's a lot of development. This building is called HQ. It's got this big building with artisan cafes and restaurants below, 2 levels of commercial and 3 levels of residential. We sold these. This is phase 2, another residential building, and this is another part of the same development, which is a childcare center. This is over the road from the university, over the road also from a private Catholic school. It's a walk towards UE head office, which is new, employing 3,000 people in one building, and they're still going to build a second building. It's not there yet. So you can see, and there's a new cardio hospital where people will travel. So all of these things are creating infrastructure changes causing growth, more employment, and good investment options. And across the road from this building HQ is this also new. It's being built right now. It's a club similar to an RSL. The Nambour RSL sold, and they're putting the money into building the Boundary. Very nice place right across the road. So there's so much in that area that's going to be lovely. Only 10 minutes from the beach, 10 minutes from Lullabar, 10 minutes from the university hospital. It's a really good location. Just to show you some performance of what we did in our last market, helping clients, which was the Sydney market, because we're now in the Queensland market. We went to Bonnyrigg. People said to us, why are you going to Bonnyrigg? Well, the research showed that they were going to flatten about 80,000 council houses. The area had a lot of gentrification, and people bought there for $395 back in 2010. We told the clients to sell in 2015. They sold for $650, made $255,000, and they were cash flow positive by $112 a week. We also went to the Ponds. 2009, put clients in there early before the market started to move for $510. Clients in 2012 had made 80,000, 100,000. They said, oh, we want to sell, we want to sell. We said, don't sell, hold. Just give it some more time, more growth is coming. 2013, it went up. 14 went up, and 15, look at the price, it went to 900,000. So a client made 390,000 and positive cash flow, $91 a week. Edmondson Park, this is where I met Mike. I bought from Mike, exactly the same. 530. Look at this client. This is not me. This client bought in February 14, and he wanted to immigrate. So he's just waiting for the 1 year ownership to lapse, so he doesn't have to, so he can get the exemption on half the capital gains tax if it's more than 12 months that you held it. He sold just after 1 year, and he made 185,000 in 13 months. That's extraordinary success. That's absolutely astounding. I had the same house, by the way, and I sold in October 16, and I actually made $5,000 less. So the time to sell in Sydney was definitely in that year. It was like great for the peak of the market. Plumpton, we did as well. $399 the entry price, sold 4 years later at $590, 191 capital gains tax, cash flow positive. Rudy Hill, a client came to us, wanted to buy his self-managed super fund. He couldn't afford to retire. He was 3 years away from retirement, so we put him into Rudy Hill Villa, which was also NRAS, so that means National Residential Affordability Scheme. You get $10,000 tax-free a year from the government for 10 years. So he's adding $10,000 every year to super fund. And then just 2 years later, he sold and he made $151,000. His super fund was only $151,000 when he came to us in 2013. So he doubled his super fund in 2 years, from 150 to 300. You cannot do that by saving, but you can do that with property. It's a very good investment to buy in your super fund, by the way. It's very clever. And when you sell, your capital gains tax is only a flat 10%. Edmondson Park, another great result here. Look at that, 484,000. They held on a little bit longer. The price kept moving, sold for over $1 million. Amazing. This is my own house, one of the ones I bought from Mike when I was just a client, long before I started being a consultant. I bought for $450. I sold in January this year, made $340,000, and it was NRAS, so I was getting $10,000 tax-free every year. Great result, great area. So all based on the research. Queensland, here's a client who's bought in Queensland and sold in Queensland in the same growth period. He bought for $600,000, $623, 3 years ago, and sold now for $852 and made $228,000 in just 3 years. So really great results. So clients like these, we are helping them exit and moving into other areas in Queensland that have got high growth potential in front of us. And last one, Meriden Plains, also Queensland, bought for just under 400. Look at that. 1 year later, 100,000. And look at the cash flow. These are the 1 and 2 bedroom townhouses. This one was the 2 bedroom townhouse that I was talking about earlier, called Ascent. All right, so that's it from me. The summary is that the research really points to areas in Brisbane and Sunshine Coast. What you want to do is establish the objectives of the investment, and then all we're doing is utilizing the research, understanding our exit point before we begin, so we know what we're going to be doing. And then you just use property proactively as a tool to achieve that financial objective. We also actively manage our clients' portfolios as long as they're our clients. And even if you came to us and you owned, I don't know, 5 properties, we would look at them, review them all, and give you a recommendation on them every year with your other properties as well. We don't charge our clients any fees. We're not buyers agents. How do we make our money? We're estate agents. So we sell for the developer. Whoever's the seller pays a commission to the estate agent. So we earn from the developer. So we don't charge our clients any fees. So that's why conversation costs nothing. If you're unsure, if you don't even know if you can buy, have a conversation. It costs you nothing. I had a client a couple of years ago now who earned $40,000 a year, wasn't sure they could buy anything. Her and her partner, and had a conversation. They did buy an investment property. They could afford it. They were surprised that they could. They didn't know that they could. They used equity in their own home and got into the market and have really done quite well. So, as I said, we don't advertise. All our business is repeat business through strong performance. So if you want to participate, I just want to tell you, because the market is so tight at the moment, I would recommend, before you have a conversation, please get your finance assessed. Get a broker, speak to someone, and then let's meet and have a chat. You can do this at the same time. There's no problem with that. If you'd like to proceed, this is not a sales tactic or a high-pressure sales tactic. You do need to put the EOI in the same day. Otherwise, the property will be sold. We used to have the grace of the developer in the past where we could have it for 2, 3, 4 days while the client's considering it. But now, if you think you want to proceed and you do see the property, and like often I see the client and I say, it's not available yet. We're waiting for some option to come. We're waiting. The minute the option comes, the EOI needs to go back to the developer same day. Otherwise, you won't have it. You always have a chance to say no, because if you put in the EOI and you change your mind, you get your $1,000 holding deposit back. But if you don't put it in, there's nothing to talk about. It'll be gone. Then do if you did that, you'd then do a trip to Queensland, have a look at the area, and then I'd say come back and sign the contract swiftly. Don't keep the developer in this current market waiting, because they have pulled contracts that haven't been signed, that have taken too long, and sold them to someone else, given the holding deposit back. For house and land, the only way we can get them now from a developer is to actually give them an expression of interest either before or on the very same day. So I'll give you an example. I saw a client way back in January, had a conversation, they wanted a house and land package. I presented it only yesterday, the EOI to go in straight away. But the client understood that and was happy and knew what he wanted, and he got what he wanted. So rather that you wait, get the right property and be able to participate in the market. So are there any questions? Please feel free to ask me now. Unmute your mics. Otherwise, if you want anything of the following next steps, I would recommend that you just let me know. The one is, would you like to understand your borrowing capacity? If yes, see a broker. I'd recommend a mortgage broker instead of your own bank. They look at across many lenders. They can give you the best deal. If you're interested in purchasing a property in your self-managed super fund, or you want to set up a self-managed super fund, please speak to me. And if you need an accountant to help you, I can recommend someone. I don't get any referral fees or anything from them. Just someone who helped me and is very efficient, can talk to you about how it works. I did my own. I had a self-managed super fund name in less than a week and was able to put expression of interest in quickly, where I heard in the past it takes weeks and weeks. It may take a few weeks to set it up, but all you need is the name on the expression of interest to start the process to secure it. And to buy in your self-managed super fund, you probably need about 150,000. 200,000, you can definitely do it. If you'd like more information on the options, I just showed you a few here. We've got other areas as well. Then let's get in contact. There's my number below. Send me a text. And if you have properties, investment properties, and you're not sure if they're in the right areas, if you should hold them, keep them, they're old, they're new, whatever, I'll be more than happy to review your portfolio for you, and there's no charge. I just do that, give you my feedback, let you know what my thoughts are on it, and that's us. So any questions from anyone?
Jeanine, can you hear me at all? Susan?
Yes, I can, Susan, yes.
Okay. My son's actually with Aussie home loans brokering. That's how I came in to get to know you. And I was at your last investment one, I think, a couple of months ago. We've just refinanced 2 mortgages that we've got. We're in the throes of it. We finally got one through. But the issue that we're finding, like we've got huge equity in our current home, is the slowness of the banks to actually, it's massive. Like they say, oh, we can get this done and dusted. And like, I mean, I feel so sorry for my son because, he's just kind of got into it. But the banks are just like, it's just taking weeks and weeks, and then it's going into months, and it's just like, seriously, like,
months. It shouldn't be months, but there are a couple of delays. I must agree. It's not with every lender. I don't know, but the market is so busy. That is the thing. And people thought COVID was going to do damage to the property market. Look at the property market through COVID. It went nuts everywhere because people were cashed up because they weren't traveling. And the migration into Queensland, like for us, is so busy. It's just, the demand is just off the charts. So we do need to be early. We do need to, we are settling on properties all the time. They do seem to get done. If there is a problem, our developers are, really good because we have a relationship with the developer. Because we have a relationship, and we, like the one I'm thinking of now, DevCon, for example, we've been selling their properties for several years now. If a client was having some problem with the bank and had to have an extra week, even 2 weeks, I had a massive problem personally myself with Commonwealth Bank making a mistake on my evaluation that caused it to be cancelled and had to do it again, and they made a mistake on the valuation the second time. I had to ask for delays for a few months, and they gave us the grace. I don't know if you get that buying on your own, and I'm just being honest because there is no relationship there. The same as a deposit, people are questioning, do you get your deposit back? If you bought a house on your own and you didn't complete, they could keep your deposit. In 25 years, we've never kept a client's deposit. I've had a client who got cancer, asked to get out of the deal after he'd signed the contract and paid deposit, and we gave his deposit back because we could sell the property to someone else. And so there are benefits from using, an organization who's got the relationships with the developer. And if anything goes wrong, we handle that conversation. When I was Mike's client, before I was a consultant, and I bought in Edmondson Park, there were water tanks outside. They never connected them. Time was going by. There was a crack in the driveway. It was just like these defects after the handover that had to be done. They went on for weeks. I didn't fight with the developer. Mike did. And he said, all your delays, according to the penalty clause, you owe Jeanine, I don't know what it was, some 10,000, 11,000. And they said, no, we're not going to pay that. And then Mike said, fine, I'll see you at the tribunals, like I'll see you in court. And then he fought for me. And then they offered me something to settle outside, which was a really good figure. But I wouldn't have got that on my own, I don't think. So that's what we do. We help our clients every way we can. That hasn't actually happened since I was a client back then with any client. But if it is, that's what we do. So even with the banks, if there's some extension that you need for some valid reason, we have to help the client. It's a reality. So it's unfortunate what's happening, but it's just because the market is so busy, Susan.
Thanks, Jeanine.
You're welcome. Any other questions? Hey, Greg, welcome. See you there. Any other questions from anyone? I'm just going to stop the recording.